Okay, now welcome back. And then today, in this segment, we are happy to have Eugene Tan from University of Toronto to discuss to talk about his paper on capital budgeting, uncertainty, and misallocation. So and then the discussants will be Guojin Chen from NTU. Okay, Eugene, you have 25 minutes, and then Guojin has another 20 minutes to discuss.
Excellent. So everyone can see my slides.
Yes.
So great. This is joint work with Ben at NUS, Alan at University of Hong Kong, and Yosuke Himura at Tokyo Institute of Technology. Okay, so and thanks guys for having me on this program. So this is kind of more of a macro take on sort of a more corporate finance question, and so it's very exciting for me to be here to get some feedback on this dimension. So what is the main motivation of this paper? So we think that there are two realities of corporate capital budgeting, which is that investment plans, so capital budgets, are typically made at the start of the fiscal year, implying that these plans are made under sort of highest uncertainty. They don't know what's going to happen for the rest of the year. And that said, capital expenses are typically incurred throughout the year, in that sense when sort of uncertainty is reduced or potentially even resolved. So this means that sort of the importance of profitability uncertainty for capital misallocation is going to determine by two levers. So first, by the ability to basically formulate good investment plans ex ante by sort of getting better information, or you can also sort of mitigate misallocation by having the flexibility to adjust investment spending ex post. So in this paper, we asked three parallel questions. First, how good are investment plans in general, and how flexible are they? With that in mind, given that we're starting two quite different levels of corporate policy, we ask, do different firms use these strategies differently? And then finally, we ask, given that there is these various ways to mitigate uncertainty, how much does uncertainty actually contribute to capital misallocation? So we answer our questions in a twofold approach. So from data perspective, we bring in new data to help us establish some facts about investment planning. So this data comes from Japan, where we basically have a panel of data of firm level expectations, and then as well as the balance sheet of the firm. So this means that we can look at how expectations and plans, how these beliefs, they translate into actions, while simultaneously controlling for different firm characteristics. And our main findings are as follows. So our first fact is that investment plans are not simple conduits for expected productivity. So if you think about sort of the standard investment model, you typically say something like, I make a plan subject to expected future outcomes. But what we are finding is that this is not the only reason why plans matter. And sort of as a spoiler alert, through the lens of our model, we're going to argue that heterogeneity in uncertainty matters. Now, fact number two is that we find that investment plans are partially flexible. So firms are able to sort of respond to real-time shocks even after they have made a plan. That said, firms do not respond fully to real-time shocks because these plans are costly to adjust. So it's a headline number, for instance, if we want to think about it, for the average firm in Japan, a one standard deviation adjustment, either positive or negative, corresponds to about a $2 million loss in profits. So that's our data, and this is kind of the facts that we have. But the issue is that these facts do not tell us very much about how the data translate to the capital misallocation. So what we do from the theory perspective is that we write out a new model of firm investment dynamics, where we have very standard sort of ingredients from the literature, but then we modify these models to allow for endogenous learning, so endogenous investment plan formation, as well as partially flexible investment plans to reflect what we see in the data. So through the lens of our model, we're going to argue that investment plans actually capture both expected profitability as well as a different channel, which is that they also capture differential precision of these expectations. In particular, precision is going to be endogenous and heterogeneous across firms in the economy. And so this heterogeneity is going to give us a key prediction, which is that higher productivity firms, they actually have higher returns to learning, and so they tend to make fewer mistakes. And we find that this is consistent with our data. So from a micro perspective, this new mechanism tells us that good information is most valuable to high productivity firms, whereas investment flexibility turns out to be more valuable to low productivity firms. So if you're a poor performing firm, you're not going to hire McKinsey to give you good information. You're just going to basically hope for the best. Kind of you make a plan, hope for the best, and then when you get better information, you adjust as it goes along. Now, our micro mechanism at a macro level is going to translate into pro-cyclical learning, which in turn implies endogenous counter-cyclical uncertainty. But overall, the main message of the paper is that typical macro measures of aggregate or average uncertainty, they really do mask very large heterogeneity in firm-level uncertainty. And this kind of effect is actually not innocuous. So we find that ignoring the underlying heterogeneity actually greatly overstates capital misallocation due to uncertainty. So I'll talk more about this going forward, but the basic idea is that you can have a counterfactual economy with the exact same average uncertainty as our economy. That counterfactual economy is going to basically predict total factor productivity losses that are about 10 times higher, so substantially overstating misallocation. Okay. So this is a relatively short talk, and so I'm going to skip the lit review, but as usual, we built on the shoulders of giants. All right. So going to the data section first, we use two concurrent data sets in Japan. So the first data set is called the Business Outlook Survey. And the main part of this BOS survey is that we have these quantitative questions on sort of realized and expected sales, profits, and investments. This gives us sort of the investment plan part of the data. Then we bring in a second data set called the Financial Statement Statistics of Corporations, which is actually the exact same sample as the BOS. But this sample gives us sort of the balance sheet of the firm and other common variables that we use in macro, like employment. So what that means is now we can actually map the firm belief into firm actions while simultaneously controlling for firm level characteristics. And so before I move on to give you my main facts, I think it's useful to sort of set the stage for our actual measurement strategy. So in our paper, we consider two key sets of variables. So the first set is what we call fundamentals, which are basically realized total factor productivity, expected TFP, and TFE shocks. Now, the issue with using TFP as a measure of fundamentals is that it's going to be sort of very reliant on certain parametric assumptions of the firm's production process. So in the paper, we try to sort of show that our results are also robust to using less processed variables like sales and profits. Okay, now our second set of variables are investment variables, basically realized investments, investment plans, and deviations from plans. And this is relatively straightforward. So basically, when you see deviations from plans, we're just going to have sort of the difference of realized investment and the planned investment normalized by capital. So you can think of as deviations in growth rates. Okay, so fact number one, plans are not simple conduits through which expected productivity work. So what we have here is we basically run a regression of investment rates on certain expected performance measures. So our preferred specification is the one that I put in the red box here, which is expected productivity. So if you look at the fifth column, we basically see that if you expect productivity to be higher, you're going to invest more. If you expect productivity to be lower, you're going to not invest as much. So a very standard channel that you see in any investment models. Now, what is a bit different is that once we sort of throw in investment plans as an additional regressor, investment plans greatly attenuate the importance of TFP, of expected TFP, and also the R-squared increases by a lot. So this to us suggests that investment plans, they're not simply about expected productivity. They're actually capturing much more information than that. Now the issue with this regression is they cannot tell us what this additional information is. So we're going to sort of explain this through the lens of a model, which I'll talk more about going forward. So that was fact number one. Now, fact number two is that investment plans are actually partially reversible. So the way that we do this is we run a regression of investment plan deviations on, again, shocks to performance measures. So our preferred specification is the one that I have in this box here, which is in column 5, where we run a regression of investment deviations on TFP shocks. So if you look at the coefficient, you can see that if you get a higher than expected TFP, you invest more than what you plan. Likewise, if you get a negative TFP shock, you're going to draw down, you're going to ramp down, draw down invest less than what you plan. So there is some flexibility to how you adjust investment. That said, firms are going to try to avoid this as much as possible, because with Factory, we see that investment plans are actually quite costly to adjust. So what we have here is we run a regression of future gross profit margin on the log of the absolute value of investment deviations. Okay, so the coefficient here is negative across all specifications, basically saying that if you have to either ramp up or draw down investment relative to your plan, your future gross profit margin is going to fall. And a simple sort of back of the envelope calculation for us shows that for the average firm, a 1 standard deviation in both directions leads to about a $2 million reduction in profits. So it's quite substantial. Okay. So with these 3 facts in mind, I'm going to present a relatively straightforward model to capture these facts, and then we're going to analyze what they mean for the macroeconomy. So the baseline environment draws from sort of Heinz paper. Okay, so we're going to have risk neutral managers. We're going to do the model in general equilibrium, and we're going to have stationary distribution. Okay, and then we're going to have representative households who supply and fixed labor, which should normalize to 1. Now these households, they're going to basically demand some kind of final good, which is going to be produced by a CS production function of this board. And our main sort of interest is understanding how these intermediate goods sort of formulate investment plans and how they sort of change their plans over time. Okay? So investment good firms, kind of similar to our measurement framework, they're going to have a Cobb-Douglas physical production function. Okay, where Z here is basically firm level productivity. We're going to assume that Z is heterogeneous and idiosyncratic and involves as an AR1 process in logs. So kind of like standard in the literature, we're going to assume that capital is quasi-fixed, so they cannot adjust capital in the current period, but labor is chosen after productivity is observed. So we're not going to see labor misallocation, we're only going to see some capital misallocation. So with that in mind, okay, I'm just going to briefly run through the model. So the main difference of our model with the standard Hoppenheim model is that essentially we're going to change the timing structure to account for information refinement over the course of the fiscal year as we see in the data. So what will happen is that within the model period, we're going to have a day period where the firm sort of doesn't really know what their productivity is. Okay, so they have to make plans with some noisy information. And then at night, they're going to observe the actual productivity, and then they're going to choose actual investment, knowing exactly what productivity is. So the fixed ideas, in the day, okay, the firm manager is going to wake up with some productivity from last period, which they know exactly what it is. Then they're going to observe some signal about their current productivity. And the key part here is that the signal precision is going to be endogenous. So the signal here is a choice variable. So they're going to choose how precise a signal they want. Now, why don't managers just choose the best signal? Because that's going to be a cost to buying information. So we're going to assume that this cost is has a constant marginal cost of increasing precision. So after observing that signal, they're going to sort of know what is the posterior distribution of productivity, and so they're going to make investment plans subject to this information. Now, why do they have to make plans? This is because at night, when they do observe real productivity, they're going to want to pick a certain investment choice that is going to be in general different from what they thought they were going to do in the day. Okay? But this is going to be costly, which is going to be subject to this adjustment cost here, parameterized by chi. Okay? So essentially in the day, the firm has to forecast the entire distribution of investment choices, and then they make one single plan subject to this. Okay. So I think I have about maybe 10 more minutes. I'm losing track of time. Okay, so I'm going to skip this part because I think it's not super crucial for today's talk. Okay, so I'm going to just jump straight to the modeling implications and sort of the key predictions we have with our model. So this is basically the meat of our paper, proposition 1. Not much time left, so instead of reading to you what the math is, the main result is basically as follows. Okay, first, more precise signals are more desirable. Everyone wants to buy better information. But, and that's point number 2, returns to learning is increasing in initial productivity. So high productivity firms, they're going to want to buy better information relative to low productivity firms. And sort of the main intuition here is that, if you think about, say, the grocery stores, right, Walmart versus my sort of bodega in the corner, in the corner. So if Walmart makes the same relative error as my corner store in terms of investment, the level impact is going to be higher. And since the level impact is higher, Walmart has an incentive to basically buy better information to reduce the relative errors they make in the night period of the model. Okay, so this is kind of the main economic concept we have in this paper. So our proposition and a bunch of associated corollaries give us 2 predictions associated with the returns to learning in prediction 1, as well as the partial flexibility of investment plans in prediction 2, that we do sort of verify with the data, and we find that this is very consistent with our model. Okay. I'm not going to go through the exact regression framework. It's not super relevant, but the point is that we do find strong support for our model in the data. Okay, so now going to our results section, it's quite a long paper, so we have 3 sort of very large sets of results. For the purposes of today's talk, I'm going to focus on the second result. Okay, but we do find very interesting results for the other the other question that we tried to answer. Okay, so for the first one, basically we find that unsurprisingly, everyone wants to buy better information, but high productivity firms, in terms of their corporate policy, they leverage much more on getting better information, whereas low productivity firms, they leverage much more on investment flexibility. And then point number 3 here is that our micro mechanism, which is entirely founded only on looking at these corporate investment policies, turns out that they translate into a model with aggregate shocks and endogenous countercyclical uncertainty. Okay, so basically our basic mechanism here implies that there is pro-cyclical learning, and because there is pro-cyclical learning, that generates countercyclical uncertainty. So if you come from the macro angle, our model basically generates endogenous countercyclical capital misallocation. Okay, so returning back to point 2, okay, which is about the rule of uncertainty in capital misallocation. So I'm going to skip right to the relevant slides here, which is that we want to answer 2 questions. The first question we want to answer is fundamentally how much capital misallocation there is due to uncertainty. The second question we want to ask is basically, we know that these firms have 2 huge levers that they can use to mitigate misallocation. And so exactly how much misallocation is mitigated by these levers of capital budgeting. So our main counterfactual is going to be a model where, firstly, we're going to have exogenous uncertainty. And in particular, we're going to have homogeneous uncertainty by basically imposing the same amount of uncertainty across all firms. And this is similar to the framework in David and Venki's AR paper, and also our Moss paper in sort of a similar topic. The second thing that we have is that we're going to assume that in this counterfactual that there is fully irreversible investment plans. So once you make the plan, you cannot move away from it. And this is similar to the assumption in Tanaka et al. In JME. So what we're going to do is basically, in this counterfactual, we're going to re-estimate this counterfactual model to match the same average uncertainty in our model. And therefore, this helps us to basically understand and decompose how much of uncertainty mitigation comes from an optimal allocation of resources to planning versus investment flexibility. And this is what we're going to try to do here. And the big sort of punchline here is that our baseline model predicts very small misallocation coming from uncertainty. Okay, so if you look at column 1, which is sort of our model baseline predictions, in terms of total factor productivity losses, it's about 0.26%. It's very small. In contrast, if you have our counterfactual model, where there is sort of homogeneous uncertainty that's exogenous, as well as complete immutable investment plans, which is in column 2. You see that total effective productivity coming from misallocate, for uncertainty is about 2.59%. So it's basically about 10 times larger than what we have in our baseline model. So we're interested in understanding kind of why is this happening. And our first sort of gut instinct was that probably the reason why all this excess misallocation is happening is because we are assuming that investment is completely inflexible, right? That firms cannot adjust investment exposed, and that this is why there is so much misallocation. Turns out that our gut instinct is wrong, okay? So what we find is that the bulk of the excess misallocation is not coming from investment flexibility, but really coming from the homogeneous uncertainty assumption. Okay? So the way that we did this is as follows, okay? In column 3 here, we have the counterfactual where we allow for investment flexibility, but we continue to maintain the homogeneous uncertainty assumption. So keep in mind that in this economy, we have the exact same average measured uncertainty as in our baseline. In column 4, we flip it. We now say that you cannot adjust investment at all, but you can learn such that we still have the same average uncertainty. And what we find is that if you look at column 3, giving the option to adjust investment exposed does mitigate misallocation, but it's still quite a substantial amount. In contrast, if you allow for learning, you're basically almost all the way back to our baseline. So most of the misallocation coming from uncertainty has been mitigated. And so a big punchline here then is that, in models that sort of ignore this kind of underlying heterogeneity in learning, they're going to essentially greatly overstate misallocation. Okay. So again, I guess I have about 3 more minutes. I'm going to just go through this part too. So our big picture was saying, okay, we don't want to sort of ignore heterogeneity in learning, but we're also interested in understanding sort of how important is investment plan flexibility in helping sort of improve factor allocation. So what we did was in here we look at sort of understanding, okay, comparing sort of columns 2 and 3, okay, how much bang for your buck do you get by allowing for investment flexibility? And we find what we do find out finally is that the number of firms that are actually using this channel is quite small, and as a result, allowing for investment flexibility leads to a very small increase in the investment plan adjustment cost relative to our baseline. But if you think about the amount of uncertainty mitigation, it's quite large. So it's actually quite valuable money in that context. And in contrast, if you think about learning, okay, everyone wants to do learning if they cannot adjust their investment. So you're going to find a very large across-the-board increase in spending. And so there's about a 16% increase in basically information acquisition. And that said, because of this large across-the-board spending, this is kind of why we see such a large reduction in misallocation. Everyone wants to buy good information. And so as a result, there is improved allocation of information. And that in turn leads to improved factor allocation. Okay. So, I'm not going to go into the this section given sort of the time constraints. So I'm just going to go into conclusion. Right. So I think this is about my time, right? Yeah. Right. So just to conclude, so investment plans, they capture both idiosyncratic expectations, which is a standard channel in all economic frameworks, but we also argue that they capture the underlying precision of their information sets under which these plans were made. Okay. We also find that investment plans are very flexible in a sense, but most firms still prefer to sort of acquire better information ex ante and make good plans rather than adjust on the fly. Now, a big punchline, as I said earlier, is that if you ignore endogenous learning and ignore the flexibility of investment plans, you're going to basically overstate the role of uncertainty in misallocation. But the big source of the overestimation is going to come from ignoring heterogeneity in learning. And then finally, I don't really have time to talk about, but turns out that sort of uncertainty shocks, something that the literature has looked at, are in fact kind of optimal responses to first moment shocks because essentially through the lens of our model, returns to learning is increasing in productivity. And that's it for the paper. And thank you so much for your time.
Thank you, Eugene, for keeping strictly to the time. Now we have Guojun from NTU, MBS, to discuss the paper. Guojun?
Yes. Okay, can everyone see the slides? Okay, thank you very much for inviting me to discuss this paper. So I'm Guojun Chen from NTU. Overall, I think this is a very interesting paper and potentially important. I do learn a lot from this paper. So let me quickly summarize what I learned from this paper. So basically, this paper provides a new stylized facts from a new data. It shows that a planned investment captures important information beyond the expected TFP, beyond the expected performance, such as sales and others. And it also shows that investments plans are flexible in the sense that after the manager has made the investment, they can change that exposure. However, deviation from the investment plans are costly. And to explain such stylized facts, they introduce new model ingredients into the traditional investment literature. One is costly investment, one is costly information acquisition. Second is costly deviation from investment plans. And by doing that, they introduce, for me, which is the most important one, is the new intertemporal trade-off. This trade-off is the manager is trading off between acquiring a better information is empty versus deviating from the investment plans exposed. And by doing that, they generate a lot of interesting predictions, and they test those predictions and also do some welfare analysis. So I like this paper. So, here is a few comments when I was reading this paper, and hopefully I can provide some different angles to the authors. So the two big points are about the cost to deviate from the plans and the capital adjustment cost relating, which means the traditional physical investment adjustment cost related to Euler equation and Tobin's Q. And I also have other comments. So I can see, reading through the whole paper, I can see that the author is trying to, they're starting from a point that, okay, after the manager has made the plan, so someone might think that after they made the plan, the manager might not be able to alter the plan. So they use the stylized fact 2 and 1, showing that, okay, they can modify the plan, just that modification or deviation from that has some cost. However, I would like to start from a different perspective. So my starting point is that conceptually, what are such costs and why are such costs exist? So my starting point is very simple. I'm an individual. So people like me, we make New Year plan every year, and soon we revert it and we plan it again next year. So for me, making this plan and executing that or deviating from this plan doesn't have any material cost. I might feel guilty and my friends might laugh at me, but I don't feel any material cost. So the real question here is that why are these deviation material costs here, especially in this paper? So I think this is quite important. However, when I search through the whole paper, I do not find very detailed explanation or motivations about this cost. I can only find this sentence is that they said that in practice, the adjustment cost might manifest through financing or organizational frictions, which involve a large collection of agents coordinating to deviate from the initial plans. So, why this saying might be right? I really like to see some concrete examples and very detailed discussion here. So, the idea is that, first of all, the authors probably know that there's a very long investment literature. Most of the corporate investment literature, they have the capital adjustment cost. However, it takes the scholar a long time to accept the existence of the capital adjustment cost. So, even nowadays, people are still debating whether there's actually, such capital adjustment cost actually exists. Okay, but now, but nowadays, there are a lot of examples of that, and people understand that why capital adjustment cost is motivating from a model, motivating from a mathematical standpoint. They understand that the whole objective of the capital adjustment cost is trying to create a wedge between the internal versus external capital values. So basically, capital adjustment cost tells you that usually the internal capital has a higher value than the external one. So which the ratio gives a Tobin's cube. And from what the authors intend to do in this paper, I think they will automatically create a wedge between the plan. This plan adjustment cost is going to create a wedge between the plan versus actual investment. This is a very interesting point, but I do think they need to provide more concrete examples and tell us that what are such costs and why such costs matters. So this is a conceptual point. And the second point is still related to the plan adjustment cost, but now I want to spend a little bit time to talk about empirical foundation. So this is the equation 3 from their paper, trying to give us the stylized fact saying that if we regress the future profits over sales on the deviations from the investment plan, we do find the coefficients here is about negative 0.3. And of course, when I look at this equation, I think this might be a typo. It should be IOK instead of I here. So as the authors point out, the major concern of this regression equation is that this beta might be picking up some capital adjustment costs, which usually involve. And they try several things. They have very detailed explanations why they don't think this beta picking up the capital adjustment cost. But my concern here is that simply controlling for the investment over capital doesn't fully control away the traditional capital adjustment costs. Because usually the capital adjustment costs, they are quadratic terms, okay? So when they're quadratic, simply controlling the linear terms may not fully solve the problem. So I think adding the quadratic terms might alleviate these concerns. But it just alleviates, it cannot fully get rid of that, because later I will talk about that. The firms are making the optimal investment. They're making optimal investment. So eventually, when we text these kind of equations, just as in the investment literature, we typically just text the Euler equation. In Euler equations, it's very different. The regression equation is going to slightly different from simply setting up the model or different from the objective functions. But I will talk more about that later. So this is the first point. Second point is also that as many investment literatures, they point out that when people want to do this kind of regression, usually they want to have the denominators kept the same. The reason of that is again from the literature. Most of the time they assume constant return to scale. When they have a constant return to scale, they can normalize the whole system by a scalar. Usually it's a capital. So when they're doing that, and to be consistent with the model, usually when they're doing the regression, all the variables should be denominated by the same variable. So when they're denominating the profits by sales, this is a little bit non-standard in this literature. So the final one is an observation from the data. So as I realized at the very beginning, when they described the data, they mentioned that when the data set report the investment plan, which is IP, when some firms, about 16% of firms, they actually realize a negative investment. So the authors conjecture that they might also want to report a negative investment plan. However, the negative investment plan in this data was truncated, was censored. So we will only observe a zero investment plan when actual investment is negative. So this is going to give rise to a bias in this equation. Think about that. Suppose there's a 16% of bad performing firms. They have very negative profits. And because they have very negative profits, they are going to have very negative investment at the same time. So when they're making the investment plan, they are also very likely to report, they want to report a negative investment plan. But because of this censoring, they are going to report a zero investment plan. And the latter leads to a very large deviation, which is absolute value of the actual investment minus the investment plan. So this is very large, and the profits is very negative. This is going to lead to a very negative beta. Therefore, this kind of bias is exaggerating the negative magnitude of this coefficient beta here. So this is something I want to see more discussion from the authors. And the final one is still about the planned adjustment cost. The final standpoint is that, as I said, because I starting from the point saying that if my benchmark is that the adjustment is fully flexible, then I would like to see another welfare and policy implication. That it would be great to check the welfare implication of the planned adjustment cost. That is, the authors might want to contrast their benchmark model with a counterfactual case in which such deviation from the investment plan is costless. Okay, so this is the first big comment. The second is I want to bring this paper into this grand literature of investment. So so my thought is that to better connect with the conventional literature, the authors can follow the standard procedure. They can simply just add back the capital adjustment cost. And from what I'm reading from their model, I think that simply adding back a convex capital adjustment cost wouldn't cause any tradability issues and wouldn't add a lot of burden on their computation. The benefit is that now if they add that back, and they can now, instead of looking at their log linearization approximation, they can derive and tax the Euler equation, which is the first order condition for the investment. And the Euler equation in this model is going to look like the investment ratio equals to constant plus the marginal Q and the investment plan, and also the marginal value of the value function depending on planned capital. So the benefit of this new Euler equation is that the authors can use this to contrast with the traditional model. And we can immediately see that in the standard investment model without measurement error, these two, alpha 2 and alpha 3, it will be immediately equal to 3. Immediately equal to 0. So in this sense, the authors can contrast their models with the standard model and better text with the model, because I think this offers a very straightforward and model-related textable implication. And again, also this is very standard in the literature, so it will attract more audience in the standard literature. And now, given this background, I want to go back to the stylized facts 1 and 2 in this paper. So the stylized facts 1 and 2 is they're closely related to this Euler equation. So basically what they're texting is investment over capital, testing over the alpha plus beta investment plan, plus a lot of expected performance plus controls. So this equation can be motivated, okay, from their solutions using the log linearization. However, my concern is that log linearization is always just an approximation. It's unlike the Euler equation. Euler equation is a first order condition, and without measurement error, the Euler equation should hold everywhere, not just near the equilibrium. Especially given the data set, we can see about 16% of firms, they have negative investment, so which shows that they're clearly off equilibrium. So based on this equation, the author intend to show that beta greater than 0 means investment contain incremental information, which I do agree, but I do want to see that instead of controlling just the expected performance, they might want to actually control for the Q, which is standard in the literature. Because Q does not just contain the information in expected performance, but they also contain some information about the persistence, about how large the variance are, the signal precision, a lot of things. So I think controlling for the Q, which is a summary statistic in the traditional model, will better position their model in this sense. And therefore, I find it more convincing if the authors can try a subset of the public firms. I believe a subset of their sample firms are public firms. So for those firms, they can see their market prices, so they can construct the Tobin's Q and do the traditional, do the conventional analysis as in the standard literature. So those are my big comments. The remaining are mainly my comments for the authors. So those are minor comments. I'm just going to discuss a few. So for example, as I said, the investment plans, they are censored. There are many papers showing that the censored regressors can cause substantial biases. Potential solutions is to use the MLE, and the authors can refer to these two papers to see how they can solve those kind of issues. The second one is that I saw a lot of the regressions that only using the industry year fixed effect. I haven't seen any regression using the firm level fixed effects. So I'm a little bit concerned why the firm level fixed effects are not included in the regressions. And the remaining are expositions problems, so I'm not going to spend time on that. So let me conclude. So I think this is a very interesting paper and potentially very important. It has intriguing facts and counterfactual experiments, which is, I do learn a lot from this paper. My suggestion is that the paper needs to provide more integration and contrast with the traditional investment models. So this will make their contribution standing out and also attract more audience from the traditional investment models. And that's a lot with the paper. Thank you.
Thank you, Guojun, for the very useful discussion. Eugene, do you want to respond first before we open the floor for the attendees and panelists to ask questions?
Yeah, sure. So thank you so much for the comments. It's really useful. So I'm approaching this sort of from the macro angle. So it's very nice to have it from a corporate finance angle to sort of help us go understand what people actually care about in this literature. So I think the first point was that you're asking, what are these investment plan adjustment costs? Like, so why do they exist? So as we kind of put this in the sense that we don't, it's hard to say exactly, isolate that this is the adjustment cost. So we're trying to draw on the literature, basically saying that there seems to be in real life difficulty in moving away from your initial capital budgets. And one of the reasons could be, kind of the quote that you gave, which is that it's really hard to basically change your financing strategy overnight just because you saw this good opportunity show up in the middle of the year, right? So this is why it's costly to adjust. Now, what we're hoping with our flex and with 3 was basically saying that, hey, in the data, we do see the material costs showing up, your profits decline, regardless of whether you sort of have to adjust up or down. And so this is kind of why we put in this specific adjustment cost here. And we kind of use this quadratic adjustment cost because actually we didn't have it in the paper, but when we were doing our regressions, we found that there was no asymmetry for either going up or down. So that's kind of why we use a quadratic adjustment cost. So that was that. And then so yeah, about running about this specific comment actually by I guess by pure chance here. So you were saying that we should run a regression with a quadratic term on I over k essentially. So I think that's something we can definitely do. I think we have that somewhere. I'm just just didn't make it there to the paper. So, but thank you for the comment. I'm not super sure about how I would use the same denominator for the left-hand side variable. And so typically the reason why, at least sort of from investment dynamics perspective, if you have I over k on, you normalize everything by k. The reason is because you don't want the scale effect to show up. Right? You don't want mechanically sort of large firms obviously do larger investment because they're bigger. So this is why you normalize them by k to kill the scale effect, and you look at investment rates. That's kind of why we all the regressions that we have is in deviations from plans as normalized by capital. Now the issues for profit margin is not clear to us. And it's why is it that so a larger firms you should expect to have systematically larger profit margins relative to a slightly smaller firm. But for sure we can definitely normalize profit margins by capital. It's just something along those lines. It's something we have to think a bit more about, to be honest. And I think the sensor regression is definitely a problem. And I'm not very aware of these these techniques. So thanks for the references. And I guess if you could send me the slides, we can definitely try to address these problems for sure. Okay. Then there was a comment about the counterfactual, which is that the relevant welfare counterfactual should be the no adjustment cost model. So actually, the issue that's actually what we think of as the first best. So so all the TFP losses are computed relative to that model where there is no adjustment cost. So for instance, when I say that TFP is lower by 0.26%, that's the model. There is no adjustment cost, because that means that if there is no adjustment cost, there is no need to plan. Right? You're always doing the right thing, and so that's our first best. Yeah, so that's what we are basically already doing that. And then there was a comment on regressing investment rates on marginal Q, which is kind of the traditional Euler equation regressions. We didn't do a marginal Q, but what we have done is we have considered regressions like sales over capital, which is basically a proxy for marginal Q from the sort of the firm dynamics perspective, because sales over K capital stock, or say value added over capital stock, is basically proportional to your marginal revenue part of capital, which in turn is proportional to sort of think of as marginal Q. And so we do have regressions that sort of control for this, and I think something that you have kind of hinted at earlier. So I think we have that. Although I have to be honest in saying that I'm not super sure how this would sort of this specific regression would help our case in arguing that in sort of looking at uncertainty as a source of misallocation. Because the goal of the paper is not to challenge the investment literature saying that hey, physical adjustment costs don't exist. You should only care about planning costs, right? What we're really saying is that there's a big literature saying that uncertainty could be a big deal in affecting capital misallocation. That some firms might end up with more capital than others just because they have more information or something. So we want to see whether this is sort of relevant for a macro perspective. And from what we can tell through our model, it does seem like, at least for Japan, these firms are doing pretty well. I mean, the capital factor misallocation is very small. And then we sort of show that if we ignore this investment planning dimension, you do actually see that misallocation is much larger. So that's kind of like the big picture idea we kind of want everyone to take away from. And then the final thing about the fixed effects for the firms, we do actually have the regressions. It's kind of like buried somewhere. We didn't put it into this paper because in the model, you cannot really have fixed effects in this specific framework because there are no firm fixed effects, right? So whatever that we sort of show you about the returns to learning heterogeneity, once you throw in fixed effects, the fixed effect is going to soak up all this heterogeneity, meaning that, we say that high productivity firms, they learn more, but because the model has no explicit long run differences between firms, once you throw in a firm fixed effect plus the short panel, all these kind of heterogeneity in learning is going to be absorbed into the firm fixed effect. And so therefore, this is why we prefer to show the specification without fixed effects to sort of match what we actually do in the model. If that makes sense, I guess. Yeah. But yeah, and so I think that was the comments. But yeah, and I really appreciate all the comments that you're giving for this. This is super useful to us because, like I said, we're coming from a very different perspective, and it's kind of really nice to kind of see what other people in the corporate finance literature think about when they look at this kind of papers.
Okay, now we open the floor for discussion, for Q&A. So for the benefit of those who just joined us, so you can raise your hands. So the raise hand icon is at the bottom of the Zoom window. So you can raise your hands and then we'll activate your mic for you to speak for those attendees. And for the panelists, you raise your hands and then once we call you, you can ask your question. Okay, or if you prefer to, you can also just type in your question in the chat. All right, so let's start with Johan. Johan, you have a question?
Yes, I think Gojun already touched on this multiple times. The argument here is that deviation can be costly. Deviation in the middle of the year can be costly.
Mm-hmm. Right.
But clearly, your discussion suggests that this is optimal. It's endogenous, coming from multiple shocks, uncertainty, and so on. So I'm not sure how you can estimate the cost. Meaning, you say costly. How is it? What is the benchmark? Is the benchmark that they are not making any adjustment? Because in that scenario, then it shouldn't be costly, right? In the sense that it should be positive net effect, because otherwise they wouldn't have done it.
Right.
So,
yeah.
so that's actually so that's the part that I'm not sure I understand what you meant by cost versus benefit, because I think what you're capturing is the net benefit or net cost, whatever, whichever way you want to look at it. But you're sort of suggesting that it has negative NPV. But clearly, it cannot be negative NPV because otherwise the firm wouldn't have done it. So I'm a bit confused there because I'm not sure how you can estimate this.
Right. So I think it really is more of like a semantics issue, I guess. So what we're trying to say is that when firms, they are forced to adjust ex post, right, which is like you say is optimal when they adjust, this does reduce sort of their profit margin, so it reduces their profits relative to a world where if they didn't have to adjust. Now this is optimal. But if they didn't, from a like long run net present value perspective, which is what we have in the model, right? It is a positive NPV choice, right? It does improve your outcome relative to a world where you did not adjust your investment plans. But that's what we're trying to say is that in our model we have an adjustment cost that shows up, which says that once you adjust, you pay a cost. And so we try to sort of reflect this in the data by saying that, yeah, in fact, when they do have to adjust in response to real-time shocks, they do have a cost that they have to do.
Okay. I need to read the paper better. Okay.
Yeah. Okay, I have a question. Do you actually take into account asymmetry in the adjustment in the sense that is there a difference between adjusting upwards versus adjusting downwards investments?
Yeah, so we try to look at that specification by basically having like dummies to allow for different slopes, and we don't see any statistical difference between positive or negative adjustments, and that's kind of why in the model we model it as a symmetrical adjustment cost. Yeah.
Okay. Any questions from the floor, the audience? I think all is good. Okay, so I think maybe we'll have a longer break. We can come back at 11. So on the third paper, we will resume at 11 a.m. on Singapore time. So 20 minutes later. Okay, thank you, Gojin, and thank you, Eugene, for the very interesting discussion and presentation. Okay, I'll see you guys in a bit then at 11. Take care.
Thank you.
Thank you.
Thank you.